Hey there, my financial rebels, and welcome back to the channel. So many of you hit me up asking about the secret sauce to making serious money. And honestly, when I tell you the truth, nobody ever believes me. It is not about some magic formula or insider trading. It is about chilling out, being patient, and thinking completely opposite to the herd. Today, we're ripping apart some of the latest market headlines, and I'm going to show you why most people are getting it all wrong. First up, let's talk about Nebius. This stock is up nearly 10% just because some big shot, a guy named Leopold, decided to disclose a 5.6% stake. Seriously, a 5.6% stake. And the stock jumps 10%. Now, I'm deep into Nebius. It is a huge chunk of my own portfolio. And let me tell you, this kind of reaction just makes zero sense. It is like someone sneezes. And suddenly, the whole market catches a cold. People are acting like this Leopold guy is the next Warren Buffett, buying everything he touches to gold. He has been early on some high-flying AI names. Yeah, I get it. He was a researcher at OpenAI. His girlfriend supposedly works at Anthropic, so people are screaming insider information. And sure, maybe there is a whisper or two, but this isn't an acquisition. It is a disclosure. It is a 13G, not a 13F, meaning he is just crossing a certain threshold. His position is getting bigger. That is it. It doesn't mean the company suddenly discovered a secret gold mine. It is pure speculation, pure hype, and it is dangerous. This reminds me of the Cathie Wood craze back in 2020, 2021. Whatever she bought, whatever she talked about, stocks went wild. Then came Tom Lee and a few others. Every market cycle has its guru, and when these gurus buy or sell, the sheep follow. Does it make any sense? Absolutely none. Zero, nada, am I. Happy that my Nebius position is up. Of course, who wouldn't be? But honestly, it is not healthy if we keep seeing stocks jumping 10% because one guy bought in. Then we're deep into the crazy part of this bull cycle, where things just stop making any logical sense. Why would a stock increase 10%? Because some random guy who isn't even Warren Buffett decided to buy more. Yes, he has done incredibly well with his fund, and congratulations to him. But that shouldn't be moving the market like this. Nebius hit $240 yesterday. New all-time highs. Congrats. Some folks are already dreaming. Oh, maybe he is buying more because he knows an Anthropic deal is coming. I don't know where these theories come from. They might be true, they might not. But to me, it makes zero difference. Nebius is on the right track. Their execution has been phenomenal. Let them do their thing. This kind of news changes nothing about the fundamental business. Now, let's pivot to Snowflake, because this one's a head-scratcher too. But in a good way if you peek at the charts. Snowflake was trading around $120 in mid-April. Before they reported, it was $175 now. With the pre-market action, it is at $240, a jump of over 30%. Why the sudden explosion? Well, thanks to my buddies at Stock Market Nerd. Here is the quick breakdown. They beat product revenue estimates by 4.7%. They beat the guidance by 5.2%. EBIT estimates crushed by 38%. And they beat the 9% EBIT margin guide by 3 points. EPS estimates, 32 cents, beat by 7 cents. Their guidance also beat across the board, and they reiterated all their annual margin guidelines. This is what we call beating expectations across the board, not just meeting them. If you just meet expectations in the software world, your stock probably tanks. If your guidance isn't a little bit better, your stock gets crushed. But Snowflake is screaming, hey, we're firing on all cylinders, and our business model is the right one. They've even snagged extra partnerships with Amazon AWS and OpenAI. They're sending a clear message. AI isn't disrupting us. It is making us better, stronger, faster. And that is the golden ticket in this whole SaaS apocalypse era. Companies need to prove their resilience. Not just good results, they need to show acceleration, major improvements thanks to AI. That is how you tackle the bear thesis head on, and Snowflake just proved it. Now, let's talk about Salesforce. A completely different beast. Different business model, different growth trajectory, different profitability. What you're seeing here is their share buybacks. $27.2 billion in one quarter, and yet the stock barely moved. It is basically flat. Astonishing, isn't it? How much they're buying back, and still, no love from the market. What is going on with the business itself? Well, they're trying to show Wall Street that consumption AI is making their business better, maybe even accelerating it. They've got this flex credit thing, letting customers seamlessly shift consumption across their Agentforce apps and Data 360 headless platform. Agentforce apps are up 7% in fiscal year 2027, and Data 360 headless platform is up 15%. Total subscription and support revenue is projected to be 12% in Q1 2027. They're really trying to shout, look, we've got our core business, but we also have this Agentforce part that is growing. They've been hyping up Agentforce for a while, saying fiscal 2027 is the year it will really shine. Right now, It is nice to see Agentforce AR up 205% year over year, but it is still a tiny piece of the overall pie, too small to move the needle. Now if it keeps growing triple digits every single quarter, then yeah, it will become huge, but for now, their overall revenue is up 13% year over year. Current RPO up 14%. Agentforce apps are growing a little slower, but even with these kinds of results, the stock is flat, which means it is not enough. The market is saying, show us more, give us a reason to believe. Whether we agree or not is a different story. The business is doing okay, not exceptionally well, like Snowflake. For Salesforce to really get some traction, the market needs to trust their trajectory. In the meantime, if you believe the market is completely wrong on this, then yeah, these could be opportunities. It is not an expensive name trading at 20.3 times earnings and 12.7 times forward earnings. It is not a super fast grower like some other tech names, but it is definitely not expensive. Margins are still great. So yeah, it is a broken stock, not a broken company, but definitely a broken stock right now. And speaking of broken stocks, let's talk about Meta. Meta is still down 1.8% year to date and flat over the last 12 months. Now, you know Meta is one of my absolute favorite names and has been for a long time. I've been screaming from the rooftops. This is like Google in 2015. It is a cheap company that is growing fast. Yes, the CapEx, the capital expenditure. That is the big issue right now, but it makes perfect sense for them to spend that much money if they're seeing huge improvements internally. People constantly talk about how if Meta had a cloud business, they'd be worth a hell of a lot more than $638 per share. $1.6 trillion. And I agree. Zuckerberg himself has hinted at this. Even in shareholder meetings, he has said, look, every week, companies come to us, asking for APIs, asking if they can rent compute at a higher cost than what we paid, which means it could be a profitable business for them. But right now, they're saying all their investments are for their own internal business, and the market just doesn't want to get it. Eventually, they will, and I think eventually, Meta will say, you know what, we can do all this, and we can also set up an API, rent out some compute. And just that message alone will send the stock soaring. The question came up, Mark, with the huge CapEx build-out for AI, would you consider building a cloud to compete with AWS, Azure, etc.? And he said, it is definitely on the table. I mentioned this last year, almost every week, companies come asking for API services or to buy compute from us at a premium. We haven't done it yet because we need the compute for ourselves. But if we ever overbuild, it is an option, and that gives us confidence in our investments. It is a win-win scenario. But the market, for some silly reason, just doesn't want to believe this story. What did finally give the stock a little boost yesterday? It was up 3.3%. Meta launched Instagram, Facebook, and WhatsApp subscriptions, with more AI plans coming. For a few bucks a month, you get extra features like profile customization, super reactions, etc. There is even a subscription for Meta AI. $8 a month for Meta One Plus, $20 a month for Meta One Premium. It is still early, but they're experimenting like they did with Meta Verified, which I assume is going well. They acknowledge they're testing these AI and professional plans, but eventually they'll bring them all under Meta One. I think eventually we'll see 3 or 4 tiers, everything included, just like Amazon Prime or Google subscriptions. To me, this makes absolute sense. If you thought they'd stop with Meta Verified, you haven't been paying attention. Look at Snap, an inferior company, but Snap has over 25 million paying Snapchat Plus subscribers. That is 2.6% of their monthly active users, generating over $1 billion in annual revenue. If Meta converts the same 2.6% of their 3.6 billion monthly active users, that is an extra $4.48 billion in high margin revenue every single year. That is a 2 to 3% revenue increase. Might not sound like a lot, but we're only talking about 2.6% of 3.6 billion and only $5 or $4 a month if it is 5%. You're suddenly looking at around $10 billion extra in high margin revenue per year. These are the levers a company like Meta can pull. They have the distribution, the billions of engaged users. They can put out a few subscriptions. You don't need that many people to subscribe to make tens of billions of dollars. 2.6% is already 4.48 billion. 5% is closer to 10 billion. How fast will this ramp up? I don't know, but it shows you their potential. Everyone's terrified about CapEx, return on investment, and Reality Labs. They've said Reality Labs' losses will be the same as 2025, then improve. But people are sleeping on Meta because they're only looking at the CapEx. They refuse to see how profitable the core business is, what AI is already doing for it, and they forget Meta's track record. We did a DCF for Meta a few weeks ago, and based on the current price, for the base case, we're still seeing 35.1% upside. For the bull case, close to 80%. The bear case is 14.4% downside. That is if the whole CapEx thing completely bombs. These are my assumptions, and you can do them yourself. It is free. I think it is definitely possible. Revenue growth, EBIT margin, all realistic. We're looking at revenue around $741 billion in 2030. 5. Yes, what will happen 10 years from now? I don't know, but you make the best guess you can for the bull case. You have to be super bullish, assume all their investments pay off big time. The base case is just looking at Meta's business now, their investments, and being realistic about profitability. This is what we're reaching for the base case, and I think it makes sense. So yeah, it is still very undervalued in my opinion. When will it hit $800 per share? I don't know. But I do think Meta being hated won't last much longer. Management knows exactly what they're doing, and we've seen this before. We saw it when they invested heavily in the metaverse, even if it just helped them snag a ton of GPUs before everyone else. Yes, I think Llama 4 was a flop, but Mork is a huge step in the right direction, and once the next Muse Spark drops, which should be soon because they have a great model and can move faster. Now, these headlines will change the sentiment around Meta, and if not, then we get to buy an insanely profitable business. Still growing fast, at a discounted price, yesterday. A nice big green candle. We're going above the 100-day moving average. We're trying to close that earnings gap. To completely fill it, we need to hit $665, $670, which is around the 200-day moving average. Finally, apparently the Trump administration is chatting with drone companies about financing. So as you can guess, drone stocks are flying high. Many are already up significantly based on anticipation of more government contracts, more investments in drones, but it is not showing up in their quarterly figures yet. This is a headline-driven market, folks. Positive or negative, headlines move stocks. We saw it with AI names, memory, neoclouds, you name it, and now drones, quantum, nuclear. It doesn't matter. This isn't healthy for the long run, because in the long run, the business should do the talking. So tread carefully when you start chasing these names. Alright, that is all for me today. There is a ton of noise out there. Focus on what truly matters, and we'll be just fine. Hope you enjoyed this little rant. Have a great rest of your day. See you in the next one. Stay boring. Stay patient. Peace.